This is what your equity curve in trading is typically going to tell you as a trader. So we're going to have two different curves, curve B and we're going to have curve A over here. Now, obviously in these two curves, you can see something totally different. This one is rising steadily and consistently, while this one is more jagged, start here, end up even lower. So these are the two equity curves for these two different traders, trader A and B. Now, whichever one you are, you probably directed your attention towards that one. So everybody assumes that they want to be over here instead of being over here. But I argue that actually you want to be over here, and this is much more realistic than this. And the reason why is so simple. A lot of traders believe that your equity curve, and I know it's kind of cut off by the camera, but the equity curve is supposed to be something that goes kind of straight up. It's supposed to be something more exponential in nature, more smooth to the upside. Don't get me wrong, there are some equity curves out there that look like this, but I find that oftentimes so many traders are searching for this, searching for a strategy that may offer this. But here's the issue. A lot of the times that you see a strategy like this that may yield these types of results, or a trader that sees these types of results, oftentimes it's going to be typically one type of thing. And I'll write it here so everybody will know. Oh, cancel that out. It's going to be I know I butchered the spelling on this, but it's probably going to be a grid martingale system. Now, if you're familiar with trading, especially with algorithmic trading, you know exactly what I'm talking about, and you know exactly how dangerous this can be if you don't trade it correctly. And if you have no idea what I'm talking about, grid martingale is essentially a system where you trade on a grid, right? So maybe the grid is 20 pips or $20, whatever that unit of measurement is for your underlying instrument that you're trading. But essentially, if you can imagine that, let's just say these are different price levels. And let's just say these are price levels spread out the same amount, right? So this could be 50 pips in Forex. This could be $2 apart in stocks. It doesn't matter what it is. So basically what you're saying is price is always going to revert back to the mean. So if price comes here and it dips below this one, well, they may enter a buy. And then if it touches this one, they may enter the second buy. And if it goes up and then it enters another one, they enter another buy. And then as the market keeps going down, we enter in more buys into the market, hoping that the market will revert. And each time you open a buy, the lot size or the amount of money that you're actually putting on this trade increases compared to the first. What do I mean by that? So let's just say this was just for example purposes, so it can match every single industry out there. Let's just say you opened a $10 position on this trade. This trade may be a $15 position, and this may be a $30 position, and this may be a $75 position. And it keeps going, 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 so that when it does retrace, it only has to retrace a little bit, not way back up here, for you to be able to make a small profit on your money. Now, if you saw this example, you can clearly see how this can become very dangerous if you're trading this market. Because what if the market just keeps going down and doesn't have the retrace you want? Well, you're going to blow your account very quickly. And so many advertisements that I'm seeing now when it comes to YouTube and just different social media platforms, a lot of them is very evident and clear that they're trading systems like this, which can be very dangerous in the long run, making traders truly believe that equity curves are supposed to look like this. And I'm telling you now, this is unrealistic. And if there's a trader out there who truly has an equity curve that looks like this, it's either because they haven't been trading long enough for their, strategies edge or win rate to truly come out and show itself, or they were just a trader made by God to trade the markets and they're the best day trader in the world. But I haven't seen that yet. Typically, we're going to have A, right? And it may not look like A because obviously A is not profitable. But I argue being over here, you're in an incredible position. And the reason why is simple. So many traders, they have an edge, but they just don't realize it. What do I mean by that? In order to get from here to here, that could have been a little bit of luck, right? Anything is possible, sure. You might have gotten to a little bit of drawdown here because your emotional state started to play in. You started winning too much, whatever. But guess what? You had another increase in your equity account. So when traders show me their equity curves and it looks something like this at the beginning, right? If we could segment it and just look at this part forward, that's great news when I see that, simply because it shows me that they have some type of strategy. They have some type of edge that they're using for the market. They were making money, maybe emotions, whatever got to the play, and then they started making money again. And then ultimately, they had emotions again at this point, and that eventually just took them out because they started to get a string of losses that started to impact their mental even more. And these losses kept compounding and compounding and compounding until eventually they found themselves in a situation here where they blew their account. This is where trader A has the advantage, right? And trader B, this is purely hypothetical. Like this guy, if he exists, I don't know. It's like finding Atlantis, you know. Typically, is going to be a system like this, like we mentioned before. That's why I don't want anybody to be fooled into thinking equity curves really look like this. They're much more jagged. I'm not saying that they can't go up. Of course they can. But when they do go up, it may not look like this because this guy is having some emotional problems coming in to affect his trading, but it's going to go up in a much more like jagged pace like this, right? Instead of just a smooth equity curve. That's it's so important for traders to know that, because if you don't know that, you're going to keep looking for a strategy that gives you that. And you're going to end up buying somebody's, I don't know, grid martingale system, which is not a bad, I'm not going to say it's good or bad. It's just it needs to be traded very carefully, right? As you can see from our example. But coming back over to trader A, with this equity curve, it's incredible because he has a strategy, has an edge, it works. It's just that his emotions get into the play and it ends up blowing his account. So what can we do? We understand that the root cause of this person's unprofitability is their emotions, because they have a winning streak from about here in the market all the way up to here, and then emotions come into play, and then from here to here they have a winning streak, then emotions come into play. What if we were able to cancel out these losing streaks and for him to just have these continuous winning streaks? And even though he's going to have a few losing trades here or there, it'd never turn into a full-on streak that's going to cause him to blow his account like he did here. That sounds great, right? It sounds like it's fairy tale, it sounds like it's magic, but I propose to you, there's so many traders out there who are at this stage of their trading and they want to give up. And this is such an incredible stage to be at. Very simple reason why is because you have enough knowledge in the market for you to have a edge that works very well. You just have to cancel out the emotional component. And for most people, that emotional component is fear. Now, how do you get over fear? Getting over fear is a simple activity, but it causes you to really dig deep. And that's what I coach traders to do, is to overcome their fear and then create systems so that their fear stays basically avoided in trading. But the very simple explanation for how you can avoid these downturns and really start getting fear out of your trading, out of the market, and start experiencing these long bull runs more so than these bear runs in your equity curve, is when you're trading, there's a few components, but a few, if I could say a few for this video, A is having a probabilistic mindset. A lot of traders think that they're already trading in terms of probabilities when they're not. If you can't put on a trade and be unemotional to the outcome, then you're not trading with a probabilistic mindset, meaning you're not trading the numbers game mindset, where you understand this trade may win or lose. I don't care what it does, because I know in the long run, I am going to be making money as a trader. And I find that that mindset truly does clear up so much fear for a lot of people, is this trading with that mindset in mind. And yes, it takes practice shifting to that. Now, once we've shifted to that mindset, I like to do, well, create what I love to call, if I could write it here, perfect, 3-tier. This handwriting is terrible, but let's see. Sheesh. Guys, if you have a third grader, or guys, girls, if you have a third grader or whoever that has better handwriting, send them my way because I know that's atrocious. But I like to create a three-tier system for every trader. And I don't make it myself. I show you exactly how to make it. And a three-tier system is basically your way to remove emotions from your trading as much as you possibly can so that when you're executing on a daily basis, you won't have as much emotions, if any, in the market. And that's the whole goal. And that's how we're able to eliminate these. That's how we're able to eliminate these and focus more so on these areas of big growth that people typically see in their account. Because if you're able to bypass your emotions, that is always the thing, for the most part, that gets traders over that hump from being break even, losing to, whoa, I'm killing the market right now. And the ways that you do that is first through psychology. And once your psychology is down packed, let's create a system around that psychology to ensure that your trading stays this way for the long term. And no, that's not financial advice whatsoever. That's simply what I found. And that's why I love to teach psychology first and foremost to traders. But after teaching that psychology, let's create your system. And look, if you need any help with this or want to dive deeper or whatever the case may be, I'm coming out with some type of free resources. So check out link in description. But look, this is Trading Equity Curves. Hopefully you found that you're Trader A and you want to be Trader A because Trader A has a pretty easy fix. And look, this is RD Trades, and I'm out.